Carnival Cruise Line CCL up huge year to date, 138%. Here in quarter two, we are looking at cash and cash equivalents up near 11% in the direction we want to see. Simultaneously, the biggest news here is that revenue increased 104% compared to last May 31st and current year. Simultaneously, although operating expense increased as well at 24%, the revenue outpaced operating expense. And for the first time in what feels like ages, the operating income is not a loss for CCL, bringing in 120 million positive income. This is Intrendias. Welcome to the channel. We are looking at Carnival Cruise Line today at 120 million in profit. Is this a continued reversal to the upside from COVID lows? There's a lot of excitement for CCL in the market. However, let's not get ahead of ourselves because there are rough seas ahead. CCL is in 32 billion in debt, which is not looking so hot. Here we are seeing before COVID, CCL was around 10 billion in debt. Now we're seeing times three at 32 billion in debt. So what does that mean for the long term? What we are looking at is current debt at 1.7 billion. Current debt is the debt that's due around the 12-month period. And then there is only 4.5 billion in cash and 120 million in income for the most recent quarter. This equates to only 2.65 years of operations, assuming cash stays the same and the current debt each year is about 1.7 billion. Obviously, for a big enterprise, big company like Carnival Cruise Line, 2.6 years is not a lot. So the three possibilities I immediately see potentially happening to CCL is dilution of shares, something that investors definitely don't like to be in the pool when that happens. However, if we're only looking at 2.6 years of potential operations at 4.5 billion in cash and 1.7 of that is getting sucked up in current debt. And remember, there's 32 billion dollars in debt. So that's going to be a long-winded pain there. And CCL has to get the cash somehow. And one of the options is diluted shares. The operating income could increase dramatically in the second half of 2023. However, keeping in mind 120 million sounds great by itself. However, when you're dealing with 32 billion in debt, 120 million is quite literally nothing. We are moving in the right direction, and I would love to see CCL continue to move to the upside. However, 120 million does not really make the cut. CCL could finally take on more debt to cover current debt. However, again, they're already at 32 billion. Taking on more debt may not be the wisest choice because just like COVID, it was a black swan event that no one could have really considered in their outlook. What's to say another black swan event may occur in the near future? Hate to be pessimistic, but unfortunately, that is a possibility on the horizon. Taking on more debt, already at 32 billion in debt, 3 times more than what the debt was prior to COVID, may not be the best solution out there. With that being said, let's jump into the candlestick chart. From 2018 onward, we've been seeing a very bearish trend line. Much of 2019 was because of Cuban travel ban and rising fuel prices, and we saw a 36% decline in CCL from February 2018 all the way to January 2020. And then obviously this was COVID lows. There was some trickling back up. Interesting to note that CCL continued this downward trend that originated all the way back in 2018. You could draw a straight line through here, and that trend line is very apparent. Unfortunately, we did have a false bullish falling wedge reading here. This seemed to pose for the upside. However, we did see a continued decrease in the stock price all the way down to $6 here. We did see a correct bearish rising wedge as we had earning after earning upset. And then finally in 2023, we've been seeing some upticks for CCL, and we are now at $18.96 a share. Where do we move from here? We see a volume gap back in June 13th that will potentially be filled back up. I could perhaps see the price dropping back to the 13.99 line here, potentially fill in that volume gap before proceeding upwards. That is, of course, if they can continue increasing their operations income, continue bringing in that revenue, decrease the debt that they have on their books. $32 billion in debt compared to 120 million in operating income. It is a long, long road ahead. Not financial advice at Intrendias. However, getting in at 1896, probably not the best idea. The growth in CLL stock ever since March to now has been extremely exponential. This is not sustainable growth here. There will most likely be a cutback down to the 13.99 line, fill in this volume gap here, potentially even go lower as the balance sheet looks quite pessimistic. Sure, 120 in revenue, or excuse me, 120 in income. However, there's a lot of debt to sort through. Not financial advice, of course. However, just entertainment for you here at Intrendias. I hope you enjoyed what you've seen in this episode. Once again, the Intrendias website does provide users a free technical analysis tool to use, and our Python algorithm also spreads some sell signals as well. I would love to hear your comments down below. If you enjoy this type of content, please hit the like. It does help the channel out a lot. And if you're not subscribed already, consider subscribing. If you ever disliked the channel, you could always unsubscribe later. This has been Intrendias. Thank you for your support and watching.